Hello, I'm Alan Kohler, founder of Eureka Report, which is now part of Intelligent Investor, and finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And we are
The Money Café, Alan.
Stephen, did you miss me?
I missed you. You've been, where were you? Bali, was it? Or?
I was in Bali with my family.
Very nice.
It was
and the
lovely.
Gold Coast Conference before that, wasn't it, I think? So,
yeah, that's right, before that. So apparently Bali's Denpasar is flooded this week, so we got out in the nick of time.
Oh, well done.
The airport's closed, it's bloody flooded, and it's terrible.
Oh, climate change comes to Bali.
Apparently.
Almost ruins the Kohler family holiday.
Almost, but not quite.
So you must be full of energy, vim and vigour.
I immediately got a cold when I got back, so I'm off work, off the ABC this week because I'm too croaky and stuff.
Oh, is that right? Is that why? Okay.
Yeah.
Yes. You've done one of the last 6 I was looking at last night. So, I think your last graph was something about porridge has the numbers. I thought that was quite funny. Porridge is holding at more than 70%. That was one of your best graphs talking about
Victorian sentencing. It was
the mushroom murderer. Chances of getting a suspended sentence versus a sentence, and you made the Ronnie Barker joke about porridge. I thought that was very good.
Yes.
Now,
I'm glad you're paying attention, Stephen.
I'm always paying attention to the boss. Now, overnight, Alan, Rupert Murdoch's great mate, Larry Ellison. So I don't know if you remember earlier in the year, Rupert paid a visit into the Oval Office and was just sitting on the side watching Trump hold court. And sitting next to him was Larry Ellison. Now, Larry Ellison is the executive chair of Oracle, owns about 40%. And today, he's probably the richest man in the world because Oracle shares overnight went up 36% after a boomer AI-driven quarterly. So it's now capped at $922 billion. So the 81-year-old executive chair, mate of Rupert Murdoch, is suddenly worth $550 billion in Australian dollar terms. And we're going to have to reframe the big 7 to the big 8 or the big 9 with Broadcom also now with a market cap well north of $1 trillion. So this, AI and big tech was meant to smash the software players. Oracle is a big software player, but because they are providing backup to the big 3 in the cloud, Amazon, Microsoft, and Google are just paying them a fortune for the AI gold rush, cloud capacity and the like, and suddenly Oracle shares up 36% in one trading session, which is just ridiculous.
It's the old picks and shovels in the gold rush, isn't it? I mean,
it is.
And Nvidia's providing the picks, and Oracle and Amazon and Microsoft are providing the cloud data services for it, and everyone's suddenly woken up to the fact that Oracle's making a ton of money too. And it was just, I think, do you think that Oracle kind of got forgotten or something? And suddenly everyone realised that yesterday that actually, whoops, they're going to make money too.
Yeah. No, it's in on the game. So, and how must Rupert be feeling? I mean, if he'd only just stuck with Anna, never married Wendy Dang, never had to do endless deals with his children, he could be sitting there controlling 40% of News Corp. Instead, the poor bloke, they just had to write a check for $5 billion, Lachlan and him, to make 3 of his children go away, to seize control of the family trust. I mean, what did you make of the remarkable Murdoch peace settlement deal this week?
So I don't fully understand. Maybe you can enlighten me, Stephen. I don't really understand why Rupert and Lachlan took the others to court in Reno to try to get the trust changed. I presume they approached Elizabeth James and Prudence first to ask them if they'd be prepared to agree to the change, and I guess the 3 of them knocked them back, and so then they've gone to court in Reno to force the change, and I guess and the question is, I suppose, what changed? Did Elizabeth James and Prudence come to the view that they were going to lose in the court, or what? Or was it always about money? Do you think it was always about money? And it was always about how much Lachlan and Rupert paid James, Elizabeth and Prudence?
Yeah, so it was about money. I mean, Lachlan had previously offered 50% and 60% of the then market price, which was obviously outrageous. And the final settlement was based at 80%. But in terms of why would James and his sisters settle at 80% when they were supposedly taking the moral high ground of they were embarrassed and ashamed by Fox News, and once Dad went, would come in and do a coup and tame the wild beast and stop damaging the family name. But because James Murdoch did this sit-down interview with The Atlantic, and they ran a 13,000-word cover story in February, when James and Rupert lodged their appeal in Nevada, the other three didn't turn up because they just said, oh, this is a joke, we've already won. And then a Nevada judge, Judge Jones, gave succour and hope to Lachlan and Rupert on the basis of James being a very naughty boy and criticising them and talking to The Atlantic. So it's the old sort of, you've breached confidentiality, you're not acting in good faith. Right. And so James was worried that the appeal court might allow Rupert and Lachlan to just steal control by way of changing the trust with their top hat strategy of just giving all power to the top hat at the top and keeping everyone in purgatory with no power forever, which was their original plan. So that created judicial risk for James. And then from Lachlan's point of view, Dad's getting old. If Dad dies, I'm cooked. And in 2030, the whole thing dissolves anyway, and the 6 kids get the shares each way. It goes 1/6 each way. So then Lachlan's cooked anyway. So the deal they've done is they've got Wendy's kids to sign up till 2050. So the new trust is Lachlan, Grace and Chloe, with Lachlan in charge till 2050. So watch out for Lachlan's kids to be groomed and brought through the business over the next 20 years. And the other 3 get their 5 billion Aussie and walk away. And Lachlan and James have got a big $1 billion margin loan over their stock, but they have long-term control.
Yeah, so James should have shut up and not spoken to The Atlantic, because he would have that really mucked it up, didn't it?
Yes, well, the old gloating too early sort of situation. But it also was the single biggest disclosure in the history of Murdoch family dynamics over 100 years. I mean, the amount of stuff in there, it was incredible. All the quotes from Rupert email to second wife Anna, saying it's vital for the Western-speaking world that we retain control to stop the monolithic liberal media. It'll be a disaster for Australia if those assets fall into the wrong hands. So the insights into the world's most powerful family were damaging Rupert and Lachlan. James had run a very effective war, both a litigation war and a PR war. And so it just served all purposes to shut this thing down. And so they got a big payoff to go away. But does James shut up, or does he continue the fight because the brothers don't get on?
The other question, of course, is whether it's a goodbye for James, for Lachlan, or is this basically the peak of this company, or are they, and is it going to be in decline from here?
Well, it's hard to see Fox News getting any more profitable at the peak of Trump. And then with REA, which is the second most valuable asset in the empire, I mean, that is priced to perfection as well. It's got regulatory risk, competition risks. So, yeah, but Lachlan's argument is, look at the scoreboard. Since I've become executive chair and Dad became chair emeritus, I've almost doubled the share price over 2 years. Aren't I doing well? But I agree. I think they look a bit overpriced. And I reckon what will happen is Fox and News Corp will now merge, and then they'll demerge their holding in REA Group and cash out of REA to pay down the debt, because there's no power in REA. It's just a cash box. It's just a cash machine. But they're interested in power. They're interested in politics, and REA is all cash, no power. So to focus their control over power, which is Fox News, Wall Street Journal, all the papers, et cetera, I suspect they'll cash out of REA somehow to pay down their debts, because no one wants to have $1 billion margin loan on your stock. I mean, they've literally handed over 47% of the shares to their financier, to their ComSec, to their margin lender. It is quite leveraged, and you don't sleep well at night. Rupert's got bad memories of the 1991 debt crisis. So, yeah.
Very good. Okay, did you have you been into any interesting AGMs lately?
Look, I went to I went to Metcash yesterday. It was a really good meeting. It was 102 minutes, good questions from the floor. And what really struck me was, how there's been a lot of media about retail crime and tobacco wars, illegal tobacco. And sometimes you sort of think, is this a beat up? Is it, the press, the Murdoch press often just sort of, sowing fear in the community? But the IGA brass, the chair and CEO, they talked about 65 of their IGAs in Victoria being, held up, stolen, and now they're literally locking the doors at night, and you have to show ID to get them to unlock, to let you into a supermarket, an IGA at night. And there are big numbers that have been hit. Their staff have been having to be counselled. They link it to illegal tobacco. That what's happened is the crime gangs have got into illegal tobacco first, and now they're doing organised wholesale retail hold-ups and mass thefts. So, yeah, when you hear it from the horse's mouth, 65 of our stores have been attacked in the last little period. It was quite sobering. So,
and did they say that it's mainly Victoria?
Oh, I said Victoria is the epicenter of it. It's worse in Victoria. So that narrative actually, from the coalface, from Metcash, it's true. And yeah,
have you read anywhere that explains why Victoria is the epicenter? What's going on?
Well, I think we had the slackest laws on tobacco. We didn't do licensing regimes. So the profits were greatest in Victoria, and the fire bombings were the most. I mean, in Queensland at the moment, they are legislating for massive penalties for landlords who allow illegal tobacco to be sold. New South Wales is looking into that. So Victoria was a laggard on clamping down at the state level on illegal tobacco, and the profits were greatest in Victoria, and that then created the capital to hire the people to run the gangs, and then they've just diversified. So I think it was just letting it get out of control argument, and then it just scaled up, flywheel effect maybe, for the organised crime gangs in Victoria, starting with legal tobacco and now broadening out.
Certainly is, yeah. It's a bit of a concern in Victoria at the moment, I must say. Yeah.
Yes. Another concern is big banks slashing jobs everywhere, Alan. I mean, they're only worth $650 billion and making $40 billion a year pre-tax. It's not as if they're going broke. What is going on?
I think it indicates that they can see problems down, over the horizon. They're clearly there. You're right. I mean, they're making tons of money now. Everything's fine, but they obviously think that the good times will not last. I mean, with ANZ, they've got a new CEO who's trying to put his stamp on the place, so he's turning it upside down to change the culture. I guess there's that, but it's not just ANZ, is it? It's the others too.
Well, they're all doing it. I think there's an element of keeping up with the Joneses, that the board of CommBank or Westpac say, well, hang on, if the ANZ bloke reckons they've got 3,500 staff too many and they can punt 8% of the workforce, their cost-to-income ratios are going to be better than ours. What are we doing? How are we keeping up? Are we a lazy cartel as well with too many overpaid bureaucratic staff in head office? So I think they do tend to follow each other, and the market rewards tough talk because they assume it flows through to profits, PEs, share price, etc. So ANZ has had a bit of a bump from the tough toe cutter coming in from offshore to clean up the place and increase profits, basically increase efficiency. So there's a little bit of, you got to be seen to be doing something. So that's why some of them are playing catch-up football. But I think they're risking a regulatory backlash. They've just got to be careful being seen to be too brutal because they're making huge profits. The CEOs are all very well paid. It looks a bit ruthless and greedy. And the finance sector union, quite strong, connected to Labor. So I just think they need to tread warily vis-a-vis their sort of social license and regulatory ability to, it's like closing too many branches in regional areas. You don't want to push that envelope too hard because at the end of the day, you've got a government license and you've got to be seen to be responsible.
I wonder whether they're going to replace these people with AI. I mean, they haven't talked about that, but I wonder whether that's what's actually going on.
Well, I did ask the AI question. It's my new question for this upcoming season is going to be, how many staff have we currently got? Is it going to be lower at next year's AGM? What are the best prospective opportunities for productivity gains through AI? And how hard are we pushing the envelope? So it's a nice sort of open question. So yesterday at Medcash, look, we've got 12,500 staff. There are opportunities. We're doing it with debtors. We're doing it with payroll, I think it was, but we're not expecting, a significant reduction because we're growing the business overall. So it sounded like in some parts of Metcash there will be staff losses from AI, but overall we're a growing business, so it's not going to be a net reduction. So when you've got a net reduction in staff numbers, like ANZ, 8% cut, it's a much harder sell. And I think you'd be pretty wary coming out and going, AI is great, we're going to get rid of 10% of our workforce next year and profits will be up, let's go shareholders. I mean, that's not a very sensible line in the current environment.
Yes.
Now, what about Japan, Alan? You wanted to look at the Japanese economy?
Oh, well, I was actually in Brisbane on Monday hosting an event for my friend John Wiley, who has an annual lecture at the University of Queensland in honour of his father, Rodney Wiley. So it's the Rodney Wiley Annual Memorial Lecture. And this year it was the head of the Tokyo Stock Exchange, Hiromi Yamaji, who gave it. And my job was to ask him some questions after his speech and manage the questions from the floor. But it was interesting listening to him because what he focused on was the corporate governance reforms that are going on there, and I've subsequently talked to a few people about this, and it really is a big deal because we often talk about how you need to focus more on stakeholders broadly than shareholders in Australia and the US, but what happened in Japan and what the reform over there is to go the other way. So they've, according to this guy from the Tokyo Stock Exchange, they've spent too long. Japanese companies have been focusing too much on stakeholders broadly, in particular employees and community and government and everything, and not enough on shareholders. And so the corporate governance reform that's going on is to focus on return on equity rather than simply on sales. And it's apparently working. There's big changes to the way corporate Japan operates. And is a much greater focus now on cost of capital and return on equity than has been the case. And my first question to the guy after he finished his speech was, to what extent was poor corporate governance responsible for Japan's deflation and stagnation over 30 years? And or was it the other way around, that the stagnation was responsible for the corporate governance? And he thought that was a very good question. And he said it was a bit of both. There was kind of the poor corporate governance in Japan actually worsened the economic stagnation in Japan because the companies weren't dynamic enough, and the fact that the economy was stagnating and they had deflation basically meant that companies didn't bother going for growth. The managers and boards of companies felt like there wasn't much point doing anything much because you couldn't get anywhere because the economy was stagnating. So things are turning around now, and they're now having a whole lot more takeovers and M&A activity, and companies are going for growth in ways that they never did before. And we're now seeing inflation. Japan's economy has turned the corner. They've got inflation, and it looks like the next move of Japanese interest rates will be up at the same time as everyone else in the world, including Australia, is cutting interest rates. They're going to be increasing interest rates. So what's going to happen with Japan is the yen is entering a long bull market because Japanese interest rates are going in the other direction to everyone else's interest rates.
It is an amazing economy and corporate structure. I mean, people say that the fact they're going to have a 30% population decline and they just don't have any form of material immigration program, that's their sort of demographic challenge long term in terms of sustaining overall growth. But the calibre of their corporates globally, it never ceases to amaze me. I mean, the people, they so fly below the radar. The likes of Mitsui and Mitsubishi, they pop up with 8% of this, 10% of that, 15% of this. I mean, I reckon Japanese interests would own over $100 billion worth of Australian resources, coal, iron ore. They are absolutely enormous. I mean, people forget that, Japanese corporates, they always say they take a long-term view. So when Asahi paid $16 billion for CUB, Australia's biggest beer company, everyone's going, you're overpaying. It's crazy, No, we take a 100-year view, and we think $16 billion for CUB is a good buy. And then, of course, Kirin, the other big Japanese brewer, owns Lion, the other big Australian brewer. So 80% of the Australian beer market is just two giant Japanese beer companies, global beer players. But few people realise or even think that, no one says, oh, we're dominated by the Japanese. I mean, Altium was a great Australian tech company, electronic design software company. Renesas, Japanese company, just paid $9.1 billion cash for it in August 2024. Just came in and went, thank you, here's $9 billion, we'll have that. So they are, in global terms, they are remarkably successful, and they are enormous and very successful long-term in Australia. Ridden the mining boom like anyone, mainly because they needed to source some supplies. I mean, they always need to take equity to get the iron ore up, to get the exports flowing. Same with gas, coal, etc., because they've got few resources of their own. But it is an enormous play, and they've been very successful with no great fanfare. So it's interesting that they're going to change up the way they're going about it, because I would argue they have been corporately successful and they didn't particularly have a problem. But you're saying there's going to be a big focus on dollars and takeovers and maybe a bit more short-termism.
Yeah, well, maybe. That's right. Okay, let's move to questions. And before we do that, here's a quick word from our sponsor.
Think investing's out of reach? Think again. With InvestSmart's Fund Later, you can own a $10,000 ETF portfolio with just $4,000 up front. Fund Later covers the rest, lending you $6,000, which you repay over 20 monthly installments, including a facility fee. There's no interest, no margin calls, and no waiting. Whether you're new to investing or a parent looking to give your kids a brighter future, it's a smart way to fast-track your investment journey. Choose from 4 expertly managed portfolios and get $10,000 working for you from day one. Learn more at fundlater.com.au. Terms and conditions apply.
Okay, first question's from Philip. He says, last week's episode got me thinking about the high ASX valuations despite an average reporting season. Do you think the primary price driver is no longer fundamentals like PE ratios, but instead supply, investment options, and demand, capital? And then he goes on with some elaboration on that. Maybe we need to adapt to the new normal where the old guidance PE ratios simply doesn't apply. I don't know. What do you think, Steve?
I think there is something in this. It's a weight of capital argument that there's so much capital looking for not enough investments. And with the ASX thinning out, lots of takeovers, a lot of cashed up SMSFs with too much cash, the moment there's a dip, everyone floods in and buys the dip, because there's a lot of people saying it's overvalued, I'm waiting for the correction. And then when it does fall 5 or 10%, it gets flooded and it goes straight back up. That's been a recent phenomenon in the US as well. And a lot of that's retail money. So it is a big change. And our compulsory super system has meant that that's a reality, that we do have the capital to buy the diamonds in the rubble, but there's not a lot of rubble creation because the market never gets down that much, because it's the first sign of a sun shower and everyone's going, buy, because it's fallen 5%. So I do think there's something in it, primarily because of a thinning number of stocks on the market and $4 trillion in super, which is always looking for good value equity acquisitions.
I agree, but I'm just wary of the phrase "new normal" and the other associated phrase "it's different this time." Eventually, I think the valuations tell. Maybe there's some sort of permanent increase in valuation. I don't know. It's the same in
housing, isn't it? I mean, that statistic that we have never had a 10% drop in housing prices, top to bottom, since the recession we had to have. That's also a scoreboard argument to say there is a new normal in housing in Australia, and it doesn't crash by more than 10%. And you can maybe apply the same thing to equities. I mean, I'm saying with you, I'm totally wary of that sort of, it's different this time, and I do think it's overvalued. But we've been saying this for a while, Alan, and we're still waiting for the correction to come that we've been predicting.
I know. Yeah, but unlike housing, stock market does crash by 30% sometimes.
Yeah, we'll just go back to COVID. I mean, COVID, it absolutely got wiped out. There was all these emergency capital raisings, but anyone who got set during that period has had fantastic returns. And it's the same thing with Trump. When Trump said buy on on April the 8th this year, and there'd already been a 20% crash because of Liberation Day, that was an incredible buying opportunity. So these experiences, the short, sharp crunch, and then the sudden rebound, it just re-emphasises the perception that you should buy the dips because there's no long sustained crash. Because COVID, it was a relatively short crash. I mean, the last sustained crash we really had was the GFC, and that was absolutely hell. But if you bought in March 2009 at 3,111, which was the low on the ASX 200, I mean, you've more than doubled. That was the greatest buying opportunity of all time. And it was only people like Goldman Sachs and Warren Buffett who had enough cash, enough dry powder to really scoop up diamonds in the rubble in that wipeout environment. And they made tens of billions on that buying opportunity and became very famous for it. And a lot of people think that's the way to play it. Wait for the dip and pounce like Buffett does.
Yeah.
Now, Tim says, regular listener, love the show. Quick question. Is it possible that by allowing new home buyers into the market with a 5% deposit, the Australian government runs the real risk of negative equity in future years? Falling rates coupled with reduced deposits and costs, no LMI, appears already to be pushing the first home buyers market upwards. What do you think? Negative equity, Alan, is this a risk with this new you can buy with government backing if you've only got 5%?
Oh, yeah. I mean, I think that housing is unaffordable. It needs to become cheaper. I think that it's very unlikely that house prices are going to fall by very much, but it's possible they'll fall by 5% or more. I mean, as you say, house prices don't tend to fall by 10%, more than 10%, and even in the recession of 91, I think house prices fell by only 11%. So, and I think that the most they've fallen by, apart from that, is 9%. So, look, yeah, I mean, I think it's definitely possible. I don't think that matters that much. What matters is whether people can service their loan, and it is true that obviously with a 5% deposit, your loan is that much larger that you have to service. But as long as you can service it, you're okay. So what really matters is what the level of unemployment is, because as long as you've got your job, it tends to be okay.
Yeah, I mean, the only risk I can see is you get a massive government intervention to deliver more supply, all the rezonings and all the stuff that we're talking about at the moment. So you do actually get a whole pile of construction and supply. Then you get some massive political backlash against immigration. So you get actually politically driven significant drops in immigration. All of a sudden you've got an oversupply of housing, and then you have some sort of resources crash or some sort of AI job desert, and all of a sudden people are losing their jobs, can't afford their mortgage. And so the real stress situation comes with forced sales based on either a lender, a bank, saying you have to sell, or a borrower saying I've lost my job and I have to sell. Because what usually happens is that whenever things start to fall, no one sells, because everyone says, well, why would I sell at this price? It's come off 20%. I'd be crazy to sell. So it only really becomes a problem when you get the forced selling, which then obviously helps drive prices down further. But that's the very dark scenario that I can't see all of those things happening, because then you get interest rates at zero, government stimulus, all sorts of government responses to head that off at the pass.
And the forced selling comes about as a result of unemployment rising.
Yeah,
generally.
Yeah, that is the biggest risk, sort of an incomes wipeout based on AI and a commodities crunch. So we haven't got the mining boom anymore. Governments start having to slash government-funded jobs. effectively, like, France and the UK at the moment. They're running big deficits. The bond vigilantes are coming at them. The French Prime Minister's just resigned again because he was trying to get the deficit down from 5.7% to 4% of GDP, and the community's up in arms, protests, Prime Minister thrown out. So, if you had a government crisis that led to government cutbacks, NDIS, all sorts of government programs, that could have a big impact on employment and feed through into serviceability of that record number of mortgage debt that we've got in Australia.
Speaking of AI, interesting question from Stephen. Says a question on Thomas Friedman's article in the New York Times. The article says we need a nuclear proliferation type agreement between the USA and China to create an architecture of trust for AI. It sounds idealistic, but the article presents a compelling case that it's unavoidable if we're to avoid a situation where the only product that China would trust buying from the USA might be soya beans, and the only product US would trust buying from China might be soya sauce. With AI embedded in everything, it's not far-fetched that absence of trust will undermine any productivity gains from AI. Added to this, we have data centers consuming the planet's resources. Do you agree with the sentiments of the article? Now, I always read Thomas Friedman's articles, but I missed this one. Probably because I was in Bali or something. So I haven't actually read it. Have you read it, Stephen?
Yeah, I had a look at it, and he's basically saying he's working with the former head of research at Microsoft, and they're basically it's a little bit cataclysmic that AI could do massive damage. And we therefore need the two superpowers to work together based on trust so that you've got this interoperability, and we can't have a system of tribes where you've got, Chinese companies and China using Chinese-made AI and Americans and the Europeans doing their own. So he's basically saying we need a rules-based order. It has to be driven by the two superpowers. But frankly, from my point of view, Xi and Trump are the last two people who are ever going to get together and sort out cooperation on AI. I mean, where they're fighting over rare earths and magnets and chips at the moment. But it was very fatalistic. Like, it really was talking up, and he spent his whole summer in China looking at AI. And Thomas Friedman, who I think he's almost like Thomas Friedman's becoming to the AI like what Alan Kohler is to housing in Australia. So a well-known economic expert who's then done a deep dive into a hot area, and he's writing about it. So I think you need to listen to him. It's an interesting read, but I'm not. Yeah, I'm just not. At the end of the day, humans control AI. I just don't buy this thing that it could be used for nefarious purposes and be massively destructive to the future of humanity. I'm just not so sure that applies. Well, I mean, where are you? Are you AI? Are you downsides of AI? Where do you sit? Is it one of the big black swan risks for humanity if not managed well? If it gets into the wrong hands and is used for nefarious purposes, are you worried about that black swan risk, Alan?
Oh, I suppose I am. Yeah. I mean, I don't think we know enough about what's going to happen. I mean, I think AI is clearly a really big deal. Will AI itself take over and do like Terminator movies and, kill off humans? I don't think so, but I think that it's certainly a risk in terms of unemployment. I think that companies will kind of use. I mean, we saw Oracle share price. We talked about it before. It's up 36%. Nvidia's massive amount of money it's making, and all this money is being made by companies building the infrastructure around AI. So that everyone thinks so clearly that there's going to be a lot of AI going on because, they're spending colossal amounts of money getting ready for it. And so clearly these companies believe that everybody's going to be using AI to do stuff. So where's the money going to be made from, using AI? Well, it can only be by replacing human beings. I mean, it's just, I can't see that AI is going to somehow increase the revenue of these companies, just on its own. I think it's going to lower costs.
Yeah, it's the largest ever capital investment in lowering labour costs.
Yeah, so
That's
it's all
basically that's what it is. It's spending hundreds of billions to remove hundreds of billions of wage bills.
Yeah.
Effectively, that's the global play, and workers and their representatives in elected office are panicking about being on the wrong side of that slashing of labour costs.
Yeah, so I don't think governments are anywhere near ready for this. You know, all the governments are kind of talking about AI as being a great opportunity. We're going to increase productivity. Isn't this great? It's all fantastic. But I don't think they're in the slightest ready for this, just in the same way as they're not even slightly ready for the reality of climate change. I mean, all the governments are still working on, we're going to be net zero by 2050. But they're not going to be net zero by 2050, and they're not going to do anything about climate change, and they're not going to, AI is going to be more a risk than an opportunity, I think. But
that's
anyway.
one of the flaws of the political system, isn't it? Politicians run on a 3-year electoral cycle. So it's quite difficult or 4 years. It's quite difficult to sit there and take the sensible long-term view.
Your turn, mate.
Okay. Croaky, I'll take all the questions because you're sounding a bit croaky. So Max says, how sustainable is Australia's current reliance on fiscal stimulus and resource exports for growth, given productivity stagnation, the global push towards decarbonisation? Should we be worried about a structural current account deficit re-emerging if the terms of trade deteriorate? This has been a topic for me with my Year 12 economics class, and I want Alan to say happy birthday to my economics teacher, Miss Laman.
Happy birthday, Miss Laman.
And well done for inspiring your student Max to send the Money Café a very interesting question, Miss Laman. A very engaged student.
Or is it Laman? It's L-E-M-A-N. Is it Laman or Laman? Laman.
Oh, apologies in advance, Miss. Now, to the question? Structural current account deficit with a commodities crash because no one's using our coal and iron ore anymore, Alan, because the whole world's decarbonised. Is that a risk for us?
Well, it's a long-term risk for sure. I mean, but, China's still building tons of coal-fired power stations as well as tons of solar farms and wind farms. So I don't think it's an immediate risk. But, eventually...
We have such a diversified dowry of minerals. Our resources are so amazing that when one goes down, coal's going to go down, then copper... massive boom on copper. There's just not enough for electrification. Lithium, absolutely booming. Uranium, we've got 40% of the world's uranium or something. They all need clean green uranium to power these data centers. So we are well diversified, and it's not as if decarbonisation is just going to reduce the use of all minerals. I mean, magnets and rare earths are absolutely booming because they're needed for the decarbonisation play. So I think there's no country in the world better placed and better diversified, but we are hopeless at actually building up a long-term fund, Norwegian style. We just squander the one-off asset time and again. So when the terms of trade crunch does come, we're not going to have enough in the kitty. We're still going to have $1 trillion of federal government debt. And it is a shame we're not banking the dowry, but I think we are well placed to avoid a massive sort of recession austerity program if the current account does move against us. Now, Tom from Bathurst says, I'm really interested in what the reaction, if ever there is, with increasing private equity and superannuation here in Australia. What would the reaction be if there was a dramatic bust in the market? Would it be different to other market crashes with the increased presence of superannuation propping up the market? And would private equity that has moved companies away from the ASX change the impact of a crash this time around? What do you reckon, boss?
I
think private equity, the reason the private equity is normally okay is that their investments are ring-fenced. So you can have a disaster like PBL Media or HealthScope at the moment where your individual investment goes broke. But there's never contagion, or there's not that much contagion from one bad investment to the next, because the model of private equity is leverage it up, ring-fence the investment, give the management huge incentive and milk the crap out of it, and then sell it after 5 years after being brutal and ruthless. And that formula has delivered outsized returns. So the best private equity operators would actually be in the middle of the crash, scooping up bargains everywhere, Buffett style, Goldman Sachs style. And as for super funds, well, they've got $4 trillion, they've got captive capital. Private equity risks the super fund saying, hey, you're no good, you've stuffed up, we're yanking our money back. Private equity firm goes broke. But the super funds are the absolute power players in that dynamic because everyone's forced to put 12% in. You have to leave it there till 60. You're 60. There's never people yanking money out, and they've got this wall of capital coming in. So they would be the bedrock. The super funds would be, I think, holding up the crash and not suffering, but they would be choosing who fails by which private equity managers they ditch because they failed to, well, they copped the crash worse than others.
And I think private equity and private credit is one of the ways in which this time is different, and that is because the difference between private equity and private credit and public equity is basically liquidity. So with public equity, the share prices are quoted every day, every minute of every day, and when people kind of buy and sell, there tends to be much more of a of a herd effect. There can be much more of a stampede, in and out of stocks that are publicly listed. But private equity is not liquid at all, and nor is private credit. And I don't think, and there's much more private equity and private credit now than there has been in the past. But, either in the GFC or the 90s or the 87 crash and so on. So I don't think we really understand what impact that's going to have this time, and maybe it'll cause things to be less volatile because there's much less liquidity in the market, in ownership of capital now than there has been in the past. So I don't know.
I think there could be a reckoning in private credit in particular, which has grown too fast and has got many people who pile in. You end up taking too big risks. You come in too late to the game and your assets are crap and you pay too much and you're the first to get wiped out. Sort of last in, first out in a wipeout scenario. But liquidity is massively important. And you could even talk about the Murdochs with liquidity. The Murdoch Trust had 6 shareholders, massively wealthy, no liquidity. Because they were trapped in a trust where they couldn't get their money out and they had no power over what they did. So the 3 exiting kids have had a liquidity event where they've taken $5 billion of cash. They've got $5 billion of liquid cash, which they took in exchange for $6.25 billion of illiquid, shut-up asset that they couldn't access and was embarrassing them. So liquidity is a massively not understood issue in investment markets. You need it, you want it, you always need to be able to get out. And private credit and private equity, doesn't have the same liquidity as public markets, and that's one of the fatal problems with it. When things are tough and you want to get your money out, you can be wiped out as a private equity fund because someone yanks your money out and you're gone. Now, Kate says, love the pod, long-term listener. My financial advisor has recommended 5% of my portfolio be invested in the Bentham Global Income Fund for diversification. Despite my Googling, I can't understand what this fund does or indeed what its returns are or why it might be a good thing to own. Would be grateful if you could shed some light on that. Alan, have you heard of them, the Bentham Global Income Fund?
I've heard of them. I don't know much about them. I've been Googling them too, and I can't really tell you what they do.
Well, they're 22 years old. Their scoreboard, and scoreboard is everything in funds management, is obviously done quite well because they're quite popular. They're well diversified. They say that their value add is that they're in 300 to 400 different fixed income products globally. And they also use derivative options shorting to get the risks down, maximize the returns, and they provide consistent monthly returns. So they've got an institutional heritage through Credit Suisse, and then Credit Suisse went broke and got taken over by UBS, and now it's just owned by a couple of blokes in Sydney. So the only thing I say occasionally with these things is when you get investments being recommended by financial advisors, you've just got to also ask the question as to what is the arrangement between the financial advisor and the recommending fund. is there a financial incentive by commissions or whatever else to recommend that particular fund? But look, it's got a good track record over 22 years. So, I'm not going to come out and say, watch out, it's a shocker. But, there's always interesting issues at play in funds management. Now, Damien,
we should note that he's only recommending 5% of the portfolio be invested. He's not saying you should go all in on it. 5%'s reasonable.
Yeah, and look, income funds or credit funds. At the end of the day, it's like buying government bonds. It's credit. You rank higher than equity, and the whole structure is you get all your money back unless there's a bad debt and the fund defaults. So bonds are generally far lower risk than equity, and every good diversified portfolio should have a good whack in fixed interest for diversification. And this is just one of the funds that offer that, and they often put their money to other fixed interest funds. So they're a manager and an allocator to other bond managers globally, clipping the ticket along the way, but their returns have been pretty reasonable. Now, Damien says, it seems to me that inheritance and death taxes have an image problem. The whole idea of an inheritance is to set up your kids with all the assets you accumulate during your working life. What if there was a way to contribute maybe 10 or 15% to all the kids in Australia and set the entire next generation up for a better future? That doesn't seem like such a burden. Oh, boy. Well, Damien, that basically is an argument for a sovereign fund. That's basically saying the government should, Norway style, have a huge sovereign fund that's there to help Australia. And that's basically saying you need a strong government that can look after the community with good education, good healthcare. I don't think, you can't just have a kids fund to give kids cash. You've got to make them work for a living, don't you, Alan?
Well, yeah, Norway has a sovereign fund because they tax their resources properly, and we don't. It's an alternative to an inheritance or death tax is a decent resources tax, which I think for some reason Australian governments have shied away from. I think they should get on with it.
At its peak, Norway was running a surplus that was the equivalent of 25% of GDP. So that'd be like Australia running a $800 billion surplus or something. So that'd be just Australia owning all of the iron ore mines, all the coal mines, all the lithium, copper, gold, just having a national mining fund and not taking a miserable 2.5% royalty clip from gold miners in Western Australia, but taking the lot and putting it all into a giant fund. So we should have done that. Would have been probably quite inefficient. We should have done that. But instead, a lot of it's been, I won't say looted, but you've got three families, Clive Palmer, Twiggy Forrest and Gina Reinhardt, the three families worth $120 billion, and the whole of WA is still with $30 billion in debt. And there's no other countries in the world, aside from royal family type setups, that have seen such wealth go to so few from a government-owned resource that can only be sold once. One more question, Alan.
Just finally on inheritance taxes, I just think the other benefit of an inheritance tax is that it might enable or encourage people to die with nothing, and to give the kids the money while they're alive, which is what I think should happen, because everyone's living too long now. Everyone's living so long that by the time they die, the money's useless to the kids.
Well, Rupert's eldest, Prudence, is now 68. Rupert's 94.
That's right.
He's got many years to go. The only problem with that, Alan, is that inheritance taxes just send billionaires to Monaco. So you do get that capital is mobile argument, and you get people going and living where there's not much tax, being a tax exile.
Like tennis players.
Well, correct. I remember when Pat Rafter got given Australian of the Year in 2001 or something, and he's beaming in from Bermuda to accept his prize. And it is ridiculous. You got Brett Blundy, who's probably along with Solly Lou, the number one retailer in Australia. Lavissa, Sanity Records back in the day. He has been brilliant. But he's sitting there at a tax haven, and he was beaming into an AGM 3 years ago from a tax haven, and I asked him a tax haven question, and he's banned online questions ever since, unfortunately. But Yeah, so that's the only problem with it. But yeah,
One more question.
You can croak out the last one, Alan. Your choice.
Oh, okay, right. John says, I find it very troubling that we allowed 700,000 people to immigrate to Australia last year. It wasn't quite that, John, but anyway. And only 5,000 of these were qualified tradespeople. We need to build more houses. Tradespeople are getting increasingly expensive, and we basically don't have enough of them to build the 1.2 million houses the government wants, even if they sorted out all the red tape problems and so on. So what do you reckon? Letting more tradespeople?
Look, I think there's a short-term argument for that. The Labor Party, with its union connections, is always going to be very reluctant to go down that avenue. And you do risk sort of angry blue-collar workers, foreigners stealing our jobs, sort of political arguments to emerge when you allow that. But with AI... the big paying jobs, there's going to be more blue collar and less white collar jobs, I think, overall with AI. But look, short term, I agree. Cost of housing, cost of construction is ridiculous and hard to get tradies. It is CFMEU, you name it, does make Australia one of the most expensive places in the world to construct anything, infrastructure or housing. And one solution needs to be delicately handled politically is allowing more qualified tradies to come in, and 5,000 is a small number given the obvious problems in spiralling costs of hiring tradies.
The question assumes that the government is in any kind of control of Australian immigration, and which I think people find it very difficult to believe that that's not the case, but it isn't. I mean, the Treasury, the only kind of effort to predict how much immigration there'll be is by Treasury in the budget every year, and the last few years they've been predicting 260,000 per year, and the number that's actually arrived has been twice that. So over the last 4 years, Treasury total predictions in the budgets were 800,000 immigration, and the actual immigration was 1.6 million over those 4 years. So double what Treasury predicted, and that it tells you that the government's got absolutely no control over immigration, which is incredible.
Well, there's a massive demand. We're a great country. Everyone wants to come here. And the small business calls for it, running arguments about grow the economy, labour, you need immigration to get tax revenue up, et cetera, et cetera. But yeah, it is amazing their forecasts can be so off as well.
The skill migration program is 185,000. And so obviously what Treasury's suggesting is that the rest, which is students and working holidays mainly, will add up to 75,000, and they're completely wrong. The intake of students is massive, and so is working holidays. So they're just not in control of it, and the idea that they can somehow determine how many qualified tradespeople come here is kind of a bit fanciful, I reckon, because they've got no idea how many people are coming here.
It's a very tricky issue, Alan.
Very tricky.
Delicately handled, but I do agree the government's not handled it well with their delayed and inaccurate numbers, and it is being weaponised a little bit now on the right, but far less than many other countries where this is the hottest of hot issues of all and is sowing a lot of division, Nigel Farage, Trump, etc. So.
Yes. Thanks, everyone, for listening to today's croaky episode of Money Café. I'll be back next week with James Thompson, hopefully without a cold. So I'll send in a question. So send in your questions to us at themoneycafe@eurekareport.com.au. And we'll answer it then. Until then, I'm Alan Kohler, founder of Eureka Report and finance presenter and columnist for the ABC.
And I'm Stephen Mayne, contributor, intelligent investor, founder of Crikey, shareholder advocate, and I'll be croaking on with you all in a fortnight. Over and out, boss.
Bye-bye.